Hi, my name is Samantha Martinez, and this is my presentation on the accounting scandal of WorldCom. The business first started in 1983 as Long Distance Discount Service, or otherwise known as LDDS, and it continued to develop through many acquisitions. By the end of 1999, Sprint Corporation and MCI WorldCom announced a $129 billion merger agreement between the two companies. Had the deal actually been completed, it would have been considered the largest corporate merger in history. However, the deal was terminated after the U.S. Department of Justice and the European Union had made some concerns that it would create a monopoly. Today, it is currently known as MCI Communications Corporation, doing business as Verizon Business. WorldCom became known for being one of the largest accounting scandals and bankruptcies in the history of the United States. The scandal came to light in 2002 after the Internal Auditing Department uncovered $3.8 billion in fraud. WorldCom had inflated assets by $11 billion, leading to 30,000 people losing their job and creating $180,000 billion in losses for their investors. So how did this happen? The company said an internal audit had discovered $3.3 billion in profits were improperly recorded from 1999 to the first quarter of 2002. Accounting entries proved WorldCom had recorded maintenance expenses as capital expenditures to give the appearance of steady growth in profits. By wrongly classifying expenses, this left WorldCom with inflated profits and lower borrowing costs over a period of 5 quarters. These actions arose from the CEO's pressure to meet Wall Street's estimated earnings for the company, while WorldCom's true cash flow had actually been declining for the past years, which would have alarmed investors. Here you can see the hierarchical organizational structure within the company at the time, but more specifically how authority flows from the top. Starts with the CEO, Bernard Ebbers, and divides into branches, but the downside to this is that the communication flow can be terminated before reaching upper management. WorldCom's CEO was Bernie Ebbers, who was also named Telecom Cowboy by Business Week magazine after his bold bid to buy MCI in 1997. He co-founded WorldCom in 1995, and he was named Chief Executive Officer. He was also a Sunday school teacher at his local Baptist church, where he maintained his innocence, and he pointed blame to Scott Sullivan, who was the CFO of WorldCom at the time. In April 2002, he announces his resignation from WorldCom amid SEC investigation. The Chief Finance Officer was Scott Sullivan, and he began his career with WorldCom in 1992. He rose to CFO of WorldCom through a close-knit relationship with Bernie Ebbers by helping with acquisitions and mergers, which happened quite often. He was also a leading executive who was one of the most well-paid in his field, with more than $19 million in earnings in 1998. But in June 2002, he was fired after the accounting fraud discovery. He would also may have been considered the mastermind behind WorldCom's scheme by manipulating the numbers. Next, we have the VP of Internal Audit, Cynthia Cooper. She began her journey with the company in 1994, and she led her team to the discovery of WorldCom's accounting fraud in 2002. She raised suspicion about the anomalies of WorldCom's capital expenditures after advised by the CFO to delay audit. But she worked her way up the chain of command to get her questions answered, and this is how she ultimately got to the bottom of the discovery. Next, I will be talking about the company culture during this time. Scott Sullivan said that Bernie Ebbers pressured him to book improper accounting entries after he showed him how WorldCom was truly performing. But Ebbers' main concern was to meet Wall Street's earning expectations for WorldCom. His employees were often discouraged to bring attention to the internal issues that they were having, and Ebbers made it clear to his management team that he only wanted to hear good news. But in result, this created a culture that demanded success at all cost. Here is where they are now. In 2005, Bernie Ebbers was convicted of securities fraud, conspiracy, and filing false documents. The accounting fraud resulted in an $180 billion loss to investors and was considered the biggest bankruptcy that the U.S. had seen, leaving 30,000 people unemployed. Bernie surrendered $40 million of his assets, including his Mississippi home, and is now currently serving a 25-year sentence in a correctional institution in Louisiana with a projected release date of July 2028. As for Scott Sullivan, he was indicted on several counts of accounting fraud related to WorldCom. He pleaded guilty in 2004 and was sentenced to 5 years of prison as part of a plea agreement. He served his sentence at a federal prison in Georgia, and he was released a year early on home confinement for another 3 years. As for Cynthia Cooper, she was named Person of the Year by Time magazine in 2002. She is CEO of the Cooper Group, LLC, a management consulting firm that provides a variety of services from internal audit to ethics and compliance. She dedicates most of her time to consulting and is an internationally recognized speaker, sharing her experiences and teachings about strong ethical leadership. She is author of Extraordinary Circumstances, where she writes about what she learned at WorldCom. And that concludes my presentation.